They told you to buy the chips. They showed you the soaring stock price of the $4 trillion giant. Every headline screams AI software, LLMs, and generative hype. But there's a problem they aren't talking about. The truth is, the entire AI revolution is running into a wall. A physical, immovable wall built of concrete, copper, and power. And while 99% of investors are still arguing over who has the best algorithm, the new $5.2 trillion market is quietly being forged in the dark, hot core of the data center. If you invest based on headlines, you are already too late. This is the underground data that separates catalysts from casualties. Stick around. We show you exactly where the real money is moving right now. The underexplored anomaly is simple physics. AI workloads demand power density that is shattering old infrastructure models. A traditional data center rack uses 10 to 15 kilowatts. Today's AI racks, filled with the latest GPUs, are hitting 40 to 130 kilowatts. This isn't a 10% increase, it's a 10x burden on the grid and cooling systems. Tech titans like Amazon, Microsoft, and Google know this. They are collectively committing hundreds of billions to solve this bottleneck. We are talking about a $5.2 trillion capital expenditure forecast for AI infrastructure alone by 2030. Source: McKinsey. This market is expected to grow at a 28.34% CAGR through the next decade, significantly outpacing almost any software sector. This creates two critical forgotten investment areas: power delivery and thermal management. The biggest risk to AI growth isn't model efficiency, it's the interconnect queue for electricity and the desperate need for liquid cooling. If the infrastructure can't handle the heat, the chips go dark. That is the leverage point everyone missed. To move past the hype and identify companies serving this crisis, you must follow the catalyst criteria. These are measurable, replicable strategies that filter out noise. Here are the 3 non-negotiable filters for finding AI infrastructure winners. 1. The liquid cooling mandate. Demand stocks whose core product is essential to managing heat at 40 kW plus densities. Look for companies specializing in direct-to-chip or immersion cooling systems. This technology is 3,000 times more efficient than air cooling for AI hardware. If their revenue isn't tied to this trend, they are legacy. 2. The efficiency gate, PE reality. Check. Avoid the cognitive bias of social proof. Many high flyers trade at 100x earnings or more. Identify foundational companies with forward PE ratios below 25 and a projected revenue, EPS growth rate exceeding 40%. You need growth at a reasonable price. 3. The unsexy enablement play. Look beyond the GPU manufacturer. The next shortage isn't compute, it's high bandwidth memory, HBM, specialized power distribution units, and high-speed networking switches that link these dense racks together. These companies have high margins and deep moats, acting as essential utilities for the AI supply chain. Let's apply the catalyst criteria. On one side, you have the high-flying application layer, often trading at valuations like Palantir, PLTR, with a TTM PE that recently exceeded 280x. That price assumes zero execution error for the next decade. Now, consider a crucial enablement play. Micron Technology, MU. Micron is a leader in high-bandwidth memory, HBM, the specialized component required for training the largest AI models. HBM is the fuel for the Nvidia engine. Criterion 1. Mandate. They are essential to the next generation of AI chips. Check. Criterion 2. Efficiency gate. As of this October 2025 analysis, Micron holds a highly affordable forward PE ratio of roughly 11.08. Critically, their projected EPS growth for the coming year sits at an astounding 100.01%. Source: Zacks, OCT 2025 data. Criterion 3. Unsexy enablement. They are a foundational utility player. Check. This is the evidence-based alternative. It is the difference between buying the tool everyone is talking about and buying the only company that can provide the critical fuel for that tool, at a fraction of the psychological cost. Most investors are trapped reacting to headlines, blinded by the hype cycle. They are betting on the obvious winners. Catalysts bet on the unavoidable bottlenecks. The AI revolution isn't slowing down. It's shifting gears from training to inference and from software to power delivery. If you want the unique, data-fueled insights that expose hidden market biases and turn you into a true catalyst, you need to be here. Don't just invest, catalyze your way to the apex. Subscribe now, hit the notification bell, and tell us, what is the most undervalued power or cooling stock on your radar right now? Let us know in the comments below. We read every single one.